Well, welcome to Exploring the Impact of ESG Investments. I'm Ann Ward, a Senior Wealth Manager and Shareholder at Laurel Wealth Planning. Welcome, everyone. In a recent meeting with a client of ours, who I will call Jim and Cindy just to protect their identity, I watched as Jim turned to his wife, Cindy, and said, "Have you ever wondered if our ESG portfolio really has impact? How do we know if it's actually improving the world?" He noted that I keep reading articles that say that investment firms are false advertising, and I just wonder if this whole ESG thing isn't a scheme for investment companies to get more money because they know it matters to people. I watched as Cindy's face fell. She had been a longtime believer in ESG investing, and she had really just gotten Jim to sort of go along with this type of investing in the last couple of years. And then not long after, there was an increase in media coverage about greenwashing. So I interjected and said, "Jim and Cindy, you're right to be skeptical. We're skeptical. We also have wondered if ESG investments have the impact that they say it has and are doing what they say they're doing. Rest assured, we have researched those very questions, and I can assure you that your ESG investments are accomplishing what you want them to." I could see their concern melt away as I proceeded to share with them how we know that the strategies we pursue at Laurel Wealth Planning have impact. And I told them we could even x-ray their portfolio to help them better gauge the impact that they have. After going through that exercise, Jim said, "Well, I'm pleasantly surprised. I do feel more confident now." I can tell you that was very rewarding to hear. So we put together this presentation today because our goal is that you will come away feeling more confident about ESG investing and impact, just like Jim and Cindy did. So joining me today is Shonali Pal, who is a junior portfolio manager with Community Capital Management, or CCM. CCM is one of the managers that we have vetted, and we include them in our portfolio strategies because they're particularly strong at identifying ESG investments and measuring their impact. Shonali brings great experience to us today. She started in the firm's analyst program working with their senior portfolio managers and learning from them how to analyze the investments. She has since been promoted to a junior portfolio manager where she builds and maintains investment portfolios. She has special expertise in the ESG space. Shonali is one of the people within her firm who researches investments for their environmental and social impacts, as well as community development activities that meet the CRA, which is the Community Reinvestment Act. Shonali earned her bachelor's degree in mathematics and has a minor in economics from Villanova University. So in the next 55 minutes, we will take you behind the scenes into the world of ESG investing. First, I'll start out by defining what is ESG investing, and I'll share the journey that our clients have been on as ESG investing has evolved over time. Shonali will then talk about greenwashing and how her firm approaches selecting what we call true impact investments and avoiding the trap of greenwashing. She will then share about the various themes that you'll find in impact investing, and most excitingly, for me, will tell us true stories of impact. Finally, if you want to know how your own portfolio aligns with your values, I will tell you how to get access to a free impact assessment. So we want you to feel free to ask questions along the way. To do so, just push the raise hand button that's in the tray, and we will enable a sound, or we'll enable your sound so you can ask questions verbally. Or alternatively, you can use the Q&A chat feature to type your question. There's a Q&A button below as well. Natalie Nelson from Laurel Wealth Planning is on today to help facilitate the questions that arise. All right, well, of course, not everyone is interested in ESG investing. As wealth managers, we provide ESG investing as an offering for those who have interest. And we have found about 60% of our clients are interested, and the other 40% of our clients prefer a more traditional style of investing. Oftentimes, we find that our clients don't always understand what ESG is. So I'm going to spend the next few minutes providing an overview of ESG investing. There's a popular adage from William Shakespeare's play Romeo and Juliet, where Juliet says, "What is in a name?" That which we call a rose by any other word would smell just as sweet. The same can be said of ESG investing. Throughout time, there have been many names to describe the style of investing. What are some of the names you've heard before? You can try out that Q&A and type in some of the names that you've seen. Examples would be ethical investing, values-based investing. Anybody think of any other ones? Socially responsible investing. Yep, that one's been around a long time. Any other ones? Has anybody heard green investing or mission-related investing? Sustainable investing, responsible. That's right. More recently, you'll probably hear in the news ESG or impact investing, and still see sustainable investing as well. But any of those names are commonly used. The Forum for Sustainable and Responsible Investment, which is USSIF, defines it as an investment discipline that considers environmental, social, and corporate governance criteria to generate long-term competitive financial returns and positive societal impact. There is an important part to this sentence: to generate long-term competitive financial returns. ESG investing, as we call it at LWP, isn't philanthropy or the type of investment that deliver below market returns. That would be more of a purely social impact, such as a direct donation to charity, or providing a below market interest rate loan to, say, a company or a nonprofit. This image from CCM would put that type of opportunity on the left side of the spectrum. On the right side of the spectrum are the clients that I mentioned make up about 40% of our client base. They are utilizing traditional investments, and they have little to no interest in investing in ESG. Now, it's taken time for the industry to move from the right side into the middle. About 15 years ago, I worked for an investment firm in Bloomington, Minnesota, and I had a client who had an interest in aligning their investments with their values. So I went to the chief investment officer to ask for a solution. He did have knowledge of this type of investing, but he told me, Anne, just tell your client to invest like they're doing now and take those profits and donate to charity. You can see his thinking was on the two ends of the spectrum. Now, why would the CIO say that to me? Well, because at the time, there weren't many choices in this space, and the ones that were in place had very high fees. Those fees would eat away at performance, and many ESG funds at the time underperformed their benchmarks. So to the CIO, it was a better bet to get that higher return and donate the profit. However, my clients just didn't feel good about that. They wanted a solution where they felt good about the investments they were invested in. Many investors were vocal, like my clients, and over time were able to push the investment industry to provide solutions that met the ESG criteria, were more cost effective, and had financial returns in line with the market. So the industry also evolved from only screening out certain companies that don't reflect one's political, religious, or philosophical beliefs and values, such as say, a religious nonprofit who didn't want pornography, weapons, and gambling in their investment portfolio, to now being able to go beyond just exclusionary and avoiding screens to include best-in-class positive companies. And that's where we are today. The result, skyrocketing interest in ESG investing. When I talked about talking with that chief investment officer, it was in about 2007, 2008 timeframe, and you can see there wasn't much interest at the time in ESG investing. But as the market evolved and there were more low-cost offerings, interest really skyrocketed. So this chart shows the total assets in ESG investing in the US through 2020, and it's even increased since then. Bloomberg recently reported that ESG investing is now over $35 trillion. So today, ESG looks at environmental impact, social impact, and corporate governance. And I have examples here of the various categories in each of them. It's interesting because money managers believe that it provides better risk management to consider ESG factors when they're researching investments. Take the 2010 Deepwater Horizon oil spill, for which BP admitted cost them over $61.6 billion. BP paid dearly for their cost-cutting and risk-taking culture. It actually resulted in criminal and civil penalties, not to mention the severe ecological damage. That one oil spill was regarded as one of the largest environmental disasters in world history. And BP's stock price fell over 50% in the month following the spill. So issues like this or other issues, like the examples on the page, can really greatly impact the bottom line. ESG investing is at the intersection between making money while also improving people's lives and the well-being of the planet. A famous management consultant, John Ilkington, coined the term triple bottom line as his way of measuring performance in corporate America across not just financial performance, which was commonplace at the time, but also social and environmental performance. So you might hear something like the 3 Ps, which refers to people, profit, planet, or you might hear TBL or triple bottom line to describe the concept of ESG investing. So at this time, I want to bring in our guest speaker from CCM. As I mentioned, CCM is one of the leaders in the ESG space. We use one of their bond portfolios, which serves as a ballast to provide current income and capital preservation. And that strategy invests in well-researched fossil fuel-free bonds that have direct and measurable positive societal impact and contribute 100% positive community economic development. So with that, I'd like to turn it over to Shonali.
Great, thank you. And so I'll be going through what greenwashing is, how it started and some history behind it, and how you can recognize it. So I'm sure in recent months, many of you have seen an increase in media attention and press around ESG investing and sustainable investing. One notable article came from the former CIO of sustainable investing at BlackRock, who claimed that most of what ESG investors are saying they do is really just marketing spin. And he also indicated that this misleading messaging really creates a false sense of security and distracts from the realities at hand of climate change. So taking a step back, what is greenwashing? And it really is just that. It's the exaggeration of efforts or misleading claims that managers can make about their efforts to combat climate change. Some of this is not very surprising. We've seen a huge, immense increase in interest in ESG investing, which Anne mentioned as well. So this is illustrated in internet searches and media mentions of ESG, which you can see have really jumped in recent years. Taking a step back, greenwashing is not new. This chart goes back to 1980, but the real history goes back even further. Fossil fuel companies have been launching PR campaigns for many years to make the general public and investors feel better about the industry as a whole and distract from their own environmental issues. Since then, we've seen many more examples of greenwashing, from highlighting the use of recycled materials in just a tiny minority of products to touting initiatives that are actually required by law. The focus on greenwashing in investment managers has really increased with the increase in flows to ESG investing. And this is, again, something Anne mentioned earlier, but we've seen an immense increase in flows to ESG and sustainable funds. So assets in mutual funds which consider these factors really began to accelerate in the mid-2010s and almost doubled in 2020 from the year before. So this increase in demand means that more managers do want to participate in this growing field. This increase in demand is one factor contributing to greenwashing, but there are others. So it's easier for managers right now to make the ESG claim because there are currently very limited regulatory requirements or standards to follow in this area. And while the overall share of active managers has been declining in favor of passive management, ESG funds, which for the most part take an active approach themselves, have actually been growing. So what we've seen is many existing active managers have opted to transition their non-ESG funds to incorporate ESG factors. And this is one way they can both participate in the growth of ESG, but also justify the value that active management is providing. So now that we've identified what greenwashing is, I want to go over a few ways that you can identify it and try to avoid it. So one important step is looking at how ESG policies have shifted over time at an investment manager and how these shifts may have impacted the portfolio. So some questions you may ask would be, how has the portfolio composition changed as a result in the change in strategy? What securities have previously been included in the non-ESG approach that wouldn't be included going forward? The key is really looking at a security level to ensure that consistency is applied to the ESG policy across the portfolio. And lastly, standardization and third-party ratings can be very useful tools, but shouldn't replace your own judgment and your own analysis in analyzing the ESG policy of an investment manager. As impact managers ourselves, we are very passionate about the positive impacts that a portfolio can make on the community. And there are many other managers that are doing intentional good in their ESG approach, but the reality is that greenwashing does exist, and some managers' claims are not backed up and with consistent and intentional ESG efforts. So that being said, more transparency is absolutely needed, but not all green bonds are just marketing spin. And we believe that investors can make a difference with their money. What's important is really being diligent in the analysis of ESG claims.
We have a question here. Do you think that requirements will be established to make this more standardized?
Yeah, so that leads me pretty nicely into my next slide, which is about the SEC involvement in ESG. And so as we've discussed, greenwashing has been a main point of focus across the industry, and that includes the SEC. So one of their exam priorities for 2022 actually includes ESG as one of the 5 categories of focus. So in addition to this, they recently closed a comment period on 2 proposed changes that would specifically tackle this issue of greenwashing. And these proposals would create consistent standards, including enhanced disclosure to shareholders. And the SEC has also created a climate and ESG task force, which has many goals, but one of them is identifying and eliminating ESG-related misleading information. So to answer your question, this is absolutely becoming a growing area of focus on how to really regulate and put some requirements around this where previously there haven't been. So I'll get into our approach at CCM and how we avoid greenwashing in our impact and ESG approach to investing. So at CCM, we've developed a policy to evaluate every bond that we invest in from an impact standpoint. So our process centers around 3 main pillars, which are use of proceeds, transparency, and reporting. So for use of proceeds, we look directly at the stated use of proceeds for every bond to confirm that we believe the bond will have a positive impact on the community. So just because a bond is labeled as green or sustainable does not automatically make it eligible for us to purchase from an impact standpoint. And then even after purchase, we continue to monitor the issuer's yearly reporting to confirm that the proceeds are actually going towards those projects that we identified and meeting the criteria that worked for us from an impact standpoint. We provide detailed impact reporting showing how each investment fits into one of our 18 impact themes, which I'll discuss a little bit later. So looking at this approach in practice. I have a couple of examples on how this due diligence approach works. So the first example was a municipal bond that came to market, and it was marketed as a green bond. However, when we really dove into the use of proceeds and what the funds were being used for, we found that they were essentially being used for routine maintenance. And they were replacing old equipment or making necessary repairs, but really not going above and beyond what the issuer had to do anyway. So for us, that didn't work from an impact standpoint because it wasn't, in our view, truly a sustainable project. If the issuer was proactively working to make their systems greener or to enhance the sustainability of their equipment, that would have been one thing. But for us, we didn't see that. On the flip side, we have a bond that actually was not marketed as green and was not labeled as sustainable. But when we dug into the use of proceeds, we saw that it was going towards a wind farm that would have enabled the entire district to transition to more renewable energy. So for us, this did work from an impacts standpoint because we saw that the proceeds were being used to make a positive impact. The next example we have is two different bonds that are actually from the same corporate issuer. So the bond on the left was labeled as green and the bond on the right was not. So the green bond specified several different initiatives and projects. And when we again dug into the use of proceeds, we determined that all of the projects were truly green initiatives. The other bond was being used for general corporate purposes. And even though the company was considered best in class, it was still a nonprofit without a clear positive impact in their mission. So since we didn't really know where the money was going, it was hard for us to really make the impact claim on this one. And it did not work from an impact standpoint for us. So next I'll look a little bit at our impact approach and our impact capabilities at CCM. So our approach allows clients to customize their portfolios and direct their capital on an impact basis in a few different ways. So one is impact by geography. We also have impact by theme and by one of our 2020 initiatives, which were COVID relief and minority cares, which I'll touch on a little bit later as well. So I know there's a lot on this slide, but these are our 18 impact themes, and I really just wanted to highlight them and show or provide you with some more information for you to have after the fact as well. Every one of our impact investments is tied to at least one of these themes. So they range from affordable housing, education and childcare, minority advancement, environmental sustainability, just to name a few. And our investments could fit into more than one of these, and we'll see a few examples of that later. One of the initiatives that I mentioned that we launched in 2020 was Minority Cares, which stands for the Minority Community Advancement Racial Empowerment Strategy. And this initiative was a blend of 8 of our existing impact themes that aligned with the values of social justice. On the next slide, I have a map of where across the country we've been able to deploy capital targeting this theme of minority advancement. So with our impact reporting, which is a key benefit for our clients, we can show the cumulative impacts their investment has made by theme, by geography, and across a number of different metrics. In addition to that, for every new investment that's added to the portfolio, we provide a detailed write-up, like some that I'll discuss in a moment, showing exactly the story behind the investment, what themes it fits into, and really what the impact what the impact is of each investment that we make. So next, I wanted to dive into some of these stories. The first is a affordable rental property called Hawthorne Eco Village Apartments in Minneapolis, Minnesota. So this property is located in a low-income, majority-minority census tract that was once a set of vacant lots in the area that experienced a high crime rate. So this property not only provided much needed affordable housing to the area, but also revitalized a previously crime-ridden area. 4 of the units in the property are also set aside for people who are experiencing homelessness. The property is managed by an organization called Project for Pride in Living, which is an organization that manages around 1,300 units of safe and affordable housing throughout the city. In addition to housing, the organization provides a variety of services and employment readiness services for residents at no cost. So some of these programs include training classes for professional skills, computer literacy and interviewing skills, along with internship opportunities for residents to really help them get them on their feet. The property also includes many green elements. So it includes a system to treat rainwater, for example, and a green roof on the building. They also have a community garden next to the building that residents can access. So this property is an example of how one investment can really fit a multitude of our themes. So the affordable housing fit is pretty clear, but it's also in a majority minority census tract. So it fits for our minority advancement theme. And the building has many green elements, so it fits for our environmental sustainability theme. The next example I wanted to highlight was a municipal bond issued by the Minnesota Rural Finance Authority, which is the state's main agricultural lending arm. The bond was issued to fund 5 loan programs to provide affordable credit to eligible farmers. One of these programs was the Beginner Farmer Loan Program, it's designed for younger individuals who are looking to over time become full-time farmers. So this program is designed to help these individuals purchase their initial farm real estate and really enter the space. The other programs include the Seller-Sponsored Loan Program, the Agricultural Improvement Program, the Restructured Loan Program, and the Livestock Expansion Program. And through these programs, the RFA is really helping to develop the state's agricultural resource by offering credit on terms that wouldn't otherwise be available from other credit sources. So this makes farming more affordable and more accessible to individuals who want to be in that space. The next example is it's a rental property in New York called Barrier-Free Living Apartments. So this building has 50 units for families and 70 studios for individuals with disabilities who have been victims of domestic violence. So in addition to providing a safe space to live in this building, they also provide a number of services for residents to meet their unique needs. There's a team of on-site social workers, occupational therapists, a nurse practitioner, and a childcare specialist to assist residents in their unique challenges as survivors of domestic violence. Having all of these services available in the building where they're living really increases the accessibility and utilization of these resources for people who have been through so much. This property is in Oakland, California, and it was originally constructed as a hotel in 1912, but was remodeled into a housing project in 1978. It's currently a 315-unit apartment complex and health center for the elderly. So again, in addition to housing, the building offers a range of services specifically for its residents. And these services in this building are intentionally designed to reduce the negative impact of senior isolation. Residents receive a complete long-term health plan and can participate in a variety of health education groups. Some topics covered in these groups range from healthy eating, fitness, personal safety, even dance classes. So taken together, all of these really help to, again, reduce the impact that many seniors and elderly face and really bring the community together. My next example is a corporate bond that might be a little bit different from what you would typically think of as a corporate bond, and that is the Salvation Army. So this organization is a religious and charitable organization founded to provide spiritual support, alcohol rehabilitation, and food and shelter to the hungry and homeless. Since its founding, the Salvation Army has continued to provide additional services to meet the needs of the communities in which it operates. So these include social service programs, youth services, senior centers, and veteran services. Some brief examples of just the wide range of services provided by the organization are food pantries, daycare, parenting classes, job training, and emergency assistance in the event of disasters and emergencies, including shelter and meals. Next example is a municipal bond that was issued to finance the cost of land and water areas as part of two programs in Florida. One was the Comprehensive Everglades Restoration Program, and the primary purpose of this program was to restore the South Florida ecosystem, including the Everglades. So the real goal is to protect and preserve the water resources of this Everglades ecosystem. The second program is the Northern Everglades and Estuaries Program, which built upon existing restoration activities of Lake Okeechobee, Caloosahatchee, and St. Lucie watersheds, all of which are critical water resources in the state. This bond fits into our environmental sustainability theme as it's funding the preservation of a very critical habitat in the Florida ecosystem. And then the last example I wanted to cover was another corporate bond that this one was issued by Howard University. And Howard University is one of 101 historically Black colleges and universities in the US. As part of its mission, Howard University is providing exceptional quality education with a particular emphasis on educating Black students. One of its aims is to develop scholars and professionals who drive change and address global problems, particularly those that impact the African diaspora. Supporting historically Black colleges and universities like this one plays a critical role in working towards economic equality and social justice, which is why it worked for us for our minority advancement theme. So I know I only covered a few examples, and really there are many more that would fit each and every one of these themes across the country. There are many more stories like this one backing up every investment that we make. So before I turn it back to Anne, I just wanted to see if there were any additional questions about this part of the presentation.
All right, we have a question here. You're talking about the mission of these minority cares companies. How good is the implementation? Efficient use of money, no grifting of funds during implementation?
Yeah, that's a great question, and really brings back to what I said we do after investment. So your point is a good one, that we make all these claims up front, but really are we following through to see that these projects get implemented, or is the money just going somewhere else? And that's something we do for every bond we invest in, not just our minority cares investment, is we follow up on the use of proceeds. So it's becoming more and more common to see very detailed annual reports on how the proceeds of each bond are deployed. And these are reports that we track very closely, and we look at if the money is going where they said it was, and if the impact that we believed would be achieved by the bond is really being achieved. And what we've found in our investments, and what we found, in our analysis, is that it is, and that the projects that they said were being implemented are being implemented. And this holding the issuers accountable is really our main goal, and why we do this type of analysis throughout the life of the bond. We don't just buy it and forget it. We continue to follow up on the impact and make sure that it's being achieved. In the same way that you would monitor the financial performance of an investment, we monitor the impact performance as well.
All right, I can let you talk here. or I can read the question here, Jeannie. Bond proceeds are much easier to analyze. What about equity in companies?
That's a great point. And so what we do and the team I'm on is very focused on use of proceeds because we are a fixed income manager. And equities present their own challenges. And a lot of different managers take different approaches. Really, the important thing, in my opinion, is being consistent with your policy and having really firm, I'll say guardrails in place to make sure that it's being consistently implemented and really achieving the impacts that you claim. And that's really what greenwashing is about, is setting, making realistic claims and then having the impact approach to back them up. So different managers would view that in different ways when it comes to equities. So there's not one approach that is the right way to do it. It's really just about being consistent and honest with what you're achieving and what you're aiming to achieve.
Yeah, Jeannie, CCM is in the bond space, and we've talked about having an equity manager come in and talk about their approach to impact investing as well, because it is a bit different, and I think that would be an interesting follow-up presentation perhaps in the next year or two. But the thought is what they do is somewhat similar in terms of their due diligence and their screening and their decisions about the equities that they invest in. And then they also have an interesting avenue where they can vote their shares. So you might hear about these shareholder resolutions, and they can vote to make changes within the companies. So I know one really interesting example is one of the managers that we've worked with voted their shares. They had enough shares that they could put in a pretty strong vote for Apple to get rid of some chemicals that they had in their cell phones that were known toxins. So things like that can really impact a company when they have that shareholder advocacy and they're hearing from the owners of the company, which are all the different shareholders, to make some type of change in the organization. So a lot of change has happened because of the shareholder advocacy, and then there's similar reporting, shareholder reporting and things like that that we're able to look at with each of those equity managers as well.
All right. Are there any constraints on non-green investing that would prevent them from creating problems that ESG is attempting to clean up?
So you mean constraints on non-ESG?
So yes,
products?
it says non-green investing.
I'm not sure I entirely understand the question, but I guess I would say, so really, I mean, there are different approaches to ESG and there are different approaches to traditional investing. ESG is, I mean, what you are attempting to, the impact you are looking to have is really up to you. And I mean, that's why we offer so many different themes in terms of environmental sustainability, affordable housing. Different people want different impact out of their investments. So there's not one box that ESG investing has to fit into. And in that regard, I would say there are not constraints on what it achieves. I'm not sure if that answers the question, but I'd be happy to expand further if there's more.
Amy, do you want us to author or put your sound in there? Do you want to ask the question verbally? You can just raise your hand, push the raise the hand button if you want us to make it so you can ask the question.
Can you hear me?
Yes.
Okay. No, I'm asking, it's ESG is created to solve problems that to some extent, maybe to a large extent, are being created by a lot of money going into companies that are causing the problem, like the oil spill example that you gave.
Mm-hmm. Yeah.
So what constrains traditional investing companies, which are far more numerous, from creating a need for ESG investing. I'm not saying ESG should not be done, but it seems like there's a cleanup effect that ESG is mission that ESG is on. That's my point. Is it clear?
Yeah, sorry. So I think I understand your question now, and it's a good point. You know, there are so many companies, and if they weren't creating all these problems, then would it fall on ESG investors to fix? So I think really the big trend that will help answer this question is additional transparency. And there's really been more and more that's required to report from a governance standpoint, from an environmental standpoint, from a social standpoint, and this continued pressure to have to report on these things like carbon emissions, like issues with labor in the supply chain, like governance issues. This continued pressure and increased transparency really can only help and can make it so that the pressure really requires these companies to act in a more proactive way rather than clean up their messes after the fact, which I think is a great thing. Really, transparency would be my answer to that.
All right. I think that's everything, unless Jeannie, did you have another question here?
Who are you
Is that-
talking?
Jeannie?
Jamie. Mm.
Okay. We are good to go. Oh, one more question. Who is providing the pressure for transparency?
Yeah, that's another great question. So I'd say it's really coming from a multitude of factors. And really, one is ESG investing. And even if you're not participating in the industry or have any interest of participating, the fact is it's growing. And more companies are feeling the pressure from this industry to provide that transparency. And the other is consumers. People care now more than ever how companies are behaving and really care where the products are coming from. You know, outside of from an investing standpoint, people care that there's, no forced labor in the supply chains, that packages or products are packaged in an environmentally friendly way. People really are starting to care about these types of issues, and companies are being forced to really react to that.
And how realistic is expecting transparency in the short term because companies are resisting sensible shareholder resolutions?
Yeah, great question. I mean, so sure, none of these changes happen overnight. And really what we can do is continue working towards incremental change, increased transparency, and feeling good about how we invest our money and the products we buy. And it's really, comes from a multitude of factors, which taken together really are creating change. And, we're not naive in thinking that everything will be fixed tomorrow if you buy one green bond. Of course not, but it does create real meaningful change step by step. And the short term becomes the long term.
And I might add, until the SEC enforces actual guidelines and structure in this area, there have been a number of managers like CCM and others that we use that have developed their own methods for due diligence, double checking, figuring out what are the true impact investments. And so that area is continuing to grow. There's a lot of good managers out there that we feel go above and beyond. And there's a number of different metrics and companies that you can now hire for the investment research to go a little deeper and take it further than just the traditional style of investing would give us. These are all good questions. Do you have any additional questions for Shonali?
I have one more question for you. What made you go into this area? Where does your interest come from?
Yeah, that's a great question and one that I love to answer. So I started my career in consulting, and one of the projects that I worked on was for it wasn't in the fixed income space. It was actually in the private equity space. It was an impact analysis project. And I had already had some interest in this area through my college education, people I had met, and hearing about the space. But really looking at that project, I knew that was something that I wanted to be more involved in. And so I joined CCM about 2.5 years ago, almost 3 years ago, and have really loved how deeply integrated in our process the impact process is. And that was something that I was really looking for, because as part of that project, I had seen other approaches where the investment team and the impact team were kind of two separate, totally unintegrated things. And for me, it was important to really have impact be integral in the strategy of the firm that I joined, whatever industry, fixed income, equity, private equity. That was really crucial to me and why I'm so passionate about my job.
Very good. Thank you.
Yeah, thank you.
All right, we have a couple more questions here. One more question about transparency. Are these groups putting pressure on the SEC for this, including Congress?
Yeah, so I think the pressure on the SEC and why this has been such a focal point is really just the increase in assets. And the SEC is really looking to protect people from misleading claims. And in the same way that they're monitoring and making sure that other types of claims are being backed up, it's beyond due to have that same type of rigor when it comes to ESG claims. I hope that answers the question. I think the pressure is really just coming from the growth of the industry, and it's now become a very mainstream type of strategy that you can't really ignore, and you have to really make sure that it's being regulated.
Are there any countries that do not have the widespread profit motive Wall Street culture that are a model the industry can follow? For example, Denmark.
Yeah, that's a great question. And my expertise is really more in the United States, but there are different, cultural and different industry focuses around the world that I think can really help. Europe has been really leading the charge in the ESG space and saw this growth very early on. So that's absolutely a model that we can follow. At the same time, I don't think the work there is done yet either. I think this is a space that's constantly evolving. There's more data that's needed, more standardization, as we've talked about. There are absolutely role models that we can look up to, but we also need to just constantly be pushing the envelope ourselves and make sure that we're doing everything we can to really monitor and quantify and report on the impact of our investments.
All right, any last questions? We have a few minutes left here.
Are there any downsides to ESG investing?
That's a great question. So for me, I'm very passionate about this space, and I hope that that's been clear. I guess the downsides could be if you don't want to think about these factors and you want to take an approach like Anne mentioned earlier, where you don't want to be including this type of analysis, and you just want your investment to be investments. And to me, I think the fact that we're able to achieve market rate returns and do good is, I mean, really, to me, I think that there are no downsides, but some people do not want to incorporate these types of things in their investments and would prefer to have, you know, their charitable giving in one pocket and their investing in another, so to speak. So I think for those people, there's a clear downside in that they just are not interested in incorporating this into their investment approach, which is completely understandable. For me, I think that I really enjoy and am passionate about having these two things be intertwined.
I might add what we've seen with certain clients is they might want their portfolio to align very well with the indices. And so with this style of investing, oftentimes you're excluding different parts or different industries, different parts of the economy. A really good example is this year, a lot of the ESG equity funds have excluded oil. Well, that happens to be the top performing asset class of 2022. And so there are pockets of time where you see some variation. Over longer periods of time, we've seen ESG investing keep up and even in some cases outperform the general indices, but at times it can lag a little bit. So sometimes our clients are coming at it from that standpoint that they want to better match the index.
Yeah, that's a great point.
Quick question, why is the two pockets approach bad if the traditional funds are well chosen?
Yeah, so sorry, I didn't mean to imply that any one approach is bad. Really, for me, it's important to integrate impact analysis into our approach. But if it's important to a client to have their charitable giving in as their impact, and if there are, you know, charities that are very important to them and they want their investments to just behave as investments, that's not a bad thing. And I didn't mean to imply that it was. Just that this is an option that is available if you want your investment portfolio to also have impact and alignment with the values that you have.
That's right. We view it as an offering as well. So as mentioned, a little over half our clients are in ESG and then about 40% are not. And we view it just like any other offering when we're designing growth and income. It's just a preference. And so it's included for some and not for others. All right. Well, with that, I better wrap us up here. I have a few more things to go over. Thank you so much, Shonali. I really enjoyed hearing about the stories of impact. All right, so I wanted to come back to earlier when I mentioned that client that I was working with where Jim was skeptical about the ESG impact in their portfolio and how they now no longer are. Well, what caused that big turnaround? It was because we ran a simple report for them that x-rayed their portfolio holdings. And I was able to help them see how their portfolio aligns with the ESG issues that are most important to them. So this is a sample of the report that I ran. They were very pleased because they saw that their investments had the impact that they were hoping for in the areas that are important to them. Just wanted to say thank you for taking the time to join us today. I hope what you learned today is that if ESG investing is important to you, there are many tools available that do careful due diligence to find investments that align with important ESG criteria to you. In addition, there's methods to measure the impact in your own portfolio. There's a famous quote by Peter Lynch that I really like. He says, "Know what you own and know why you own it." His premise is that you do need to understand why you're invested in the securities in your portfolio. So many people buy investments because they've been going up or just because of a hot stock tip from a friend, and they may not even understand the investment or know what kind of business it's in. So we think Mr. Lynch's advice plays well into this ESG space. If it's important to you that your investments align with ESG principles, then I think it's worth finding out more about what you own.